Welcome back to the Deep Dive. Today we are stepping away from the scrolling ticker tapes, the quarterly earnings calls, and all that noise of the public markets.
Right.
We are heading into the quiet, slightly mysterious room in the back.
The quiet room. That sounds a little ominous.
Well, maybe not ominous, but certainly opaque.
Mm-hmm.
We're talking about private companies. I mean, think about it. If you're a public company, the market is literally shouting the value of your stock at you every single millisecond. It's on every screen.
Right. You can't escape it.
But if you're a private company, absolute silence. You have to figure out what that equity is worth all on your own.
Which, as you can imagine, creates a massive accounting headache. Without that market data, you are essentially operating in a vacuum.
Exactly. And that is our mission today. We are doing a dedicated exam prep deep dive into Chapter 13, Private Companies, from the Accounting for Equity Compensation text.
Right. And for anyone listening who's prepping for the exam, Chapter 13 is it's notorious. It's basically a minefield of exceptions.
So we're going to cover fair value when you don't have a stock price, the dreaded cheap stock issue.
Oh, yeah, that haunts IPOs.
The illusion of early exercise and that big bang of IPO expense recognition.
A lot to get through.
A ton. And we're going to wrap this up with 3 specific knowledge check questions at the very end to see if you can apply these rules. So keep your ears open.
Very.
Let's start with the fundamental conflict here. Section 13.1, the valuation puzzle.
The conflict is pretty straightforward, but it's really the root of all the complexity. The accounting standard, ASC 718, it demands you record expense based on fair value.
Right.
It doesn't give you a pass just because you're private. You still have to do the measurement.
But how? You don't have a stock price. And maybe more importantly for the math, you don't have the history that feeds into the models to get that price.
Precisely. To run an option pricing model like Black-Scholes, which is the standard, you need inputs. The trickiest one for a private company is volatility.
How much the stock price swings up and down.
Exactly. A public company just pulls its own data. A private company, well, they have no chart to look at.
So what's the workaround? You can't just, guess a number and hope for the best.
No, absolutely not. The standard requires private companies to estimate their expected volatility by looking at the historical volatility of peer companies.
This is kind of like borrowing someone else's homework.
In a way, yeah. You have to find publicly traded companies that are similar to you, similar industry, size, stage of development, and use their volatility as a proxy for your own.
You're basically saying if we were public, we'd probably act like these guys.
That's the idea.
That sounds simple enough, but I imagine the word similar is where all the arguments start.
Oh, absolutely. Picking the wrong peers is a really common audit trap. If you're a tiny pre-revenue tech startup, you probably shouldn't be using Microsoft as your volatility proxy.
Because they're too stable. Their volatility is way too low.
Right. You need peers that reflect your actual risk profile.
Now, the text here in 13.1.1 mentions this alternative method called calculated value, using an industry index instead of specific peers. This feels like a trap for the exam.
It is a bit of a trap, yes. ASC 718 technically says, sure, if it's not practicable to identify specific peer companies, you can use the volatility of an industry index.
So if I see a true-false question, the answer is true. It is allowed.
Technically, yes. But in the real world, and for understanding the standard's intent, it is almost never accepted.
Why not?
The logic is kind of circular. If you can identify an industry index that fits your business, you can almost certainly look at the companies inside that index and pick out specific peers.
So the excuse that it's not practicable doesn't really hold water.
Exactly. If you try to use that calculated value method, you are basically waving a red flag at your auditors.
Yeah.
Most companies just use the same peers they identified for their 409A valuation.
Speaking of 409A, that brings us to the stock price itself. Section 13.1.3. For a long time, there was this weird disconnect where you had one valuation for tax, the 409A, and a different one for accounting.
That was a major friction point. But we have a relatively recent update, ASU 2021-07, which introduced a practical expedient.
I love that term, practical expedient. It's basically the FASB admitting, okay, this is too hard, here's a shortcut.
Essentially, yes. This expedient allows a private company to use a reasonable valuation method, and it specifically calls out a 409A valuation to set the start price for ASC 718.
So it harmonizes the two. You use your tax number for your book accounting. That must save so much time.
It does, but, and There is always a but. You can't just use an old report. The exam will likely test you on conditions.
Right.
The valuation has to be updated for any significant events.
Like landing a massive new contract or something.
Right. And generally, the valuation cannot be more than 12 months old. It has to be fresh.
Okay, so that solves the value input. But what about the time input? Let's talk about expected term in section 13.1.2.
Expected term it's arguably the most subjective input in the whole model. It's not how long the option can live. That's the contractual term.
Usually 10 years.
Right. Expected term is how long we think the employee will actually hold it before they exercise.
And again, a startup has no history. They don't know if people cash out early or hold on.
So we have another practical expedient, and this is vital for you to note. Only private companies can use this. Public companies cannot use this shortcut.
What's the math? I heard it's simple.
It is shockingly simple. You can estimate the expected term as the midpoint between the vesting period and the contractual term.
The average.
The simple average.
Okay, let's run the numbers. Say I get an option, it vests in 4 years, and the contract says it expires in 10 years. What's my expected term?
You take the 4 years, add the 10 years, that's 14. Divide by 2. Your expected term is 7 years.
That seems incredibly convenient. Instead of some complex model, I just do 4th grade math.
It is convenient, but there are strict guardrails around it.
Yeah.
You need to memorize 4 specific criteria for the exam. Miss one, and you can't use it.
Okay, walk us through them.
First, the award has to be at the money. The exercise price equals the fair market value at grant. If you grant a discounted option, you can't use the expedient.
Okay, no discounts. Makes sense.
Second, there's a limited time to exercise after an employee leaves. Usually 90 days or so. If your plan lets them keep options for years after quitting, no shortcut.
Because that would skew the average.
Exactly. Third, the employee cannot sell or hedge the award. And fourth, this is a big one, no market conditions.
A market condition like the stock has to hit $50 a share.
Right. If you have a condition like that, the vesting is too unpredictable for a simple average to work. So the expedient is off the table.
And this is an all-or-nothing deal, I assume?
Yes. It's an entity-wide policy election. If you use it, you have to use it for all eligible awards. No cherry picking.
Got it. Okay, let's pivot to a topic that sounds great, but is an accounting nightmare. Cheap stock, section 13.2.
Cheap stock is a colloquial term, yeah, but the SEC takes it very, very seriously.
This is about that disconnect between what a private company says its stock is worth and what the public market is willing to pay.
Correct. So here's the classic scenario. You're a private company. You want to give employees options, so you get a valuation that says your stock is worth, say, $2.
Low price, happy employees, low expense. Win-win-win.
For the moment. Then a year later, you file for an IPO. The bankers come in and say, this company is hot. We can list at $20 a share.
A 10x jump in a year. That's the dream.
It's the economic dream, but it's the regulatory nightmare because the SEC steps in. They see a $2 grant and a $20 IPO price just a year apart.
And they ask,
did the value really increase 1,000% in 1 year, or were you just artificially depressing the value back then to give out cheap stock?
It's basically an audit by hindsight.
That is exactly what it is, and if the SEC decides you undervalued it, they force you to take a cheap stock charge. You have to retroactively record a massive expense hit.
Which just ruins your historical financials right as you're trying to go public.
It's painful, and it shows the tension here. The tax team wants the valuation low for 409A. The bankers want it high for the IPO. And accounting is stuck in the middle.
So even if you use that reasonable valuation expedient, that 409A report, you're not totally immune.
You're better protected, for sure, but no, not immune. The SEC has the benefit of seeing the final IPO price when they judge your past decisions.
Okay, let's talk about another situation where reality and paperwork don't match. Early exercise, section 13.3. This is when I write a check for my options before they vest.
Right. Employees do this for tax reasons. They want to start the clock for long-term capital gains, file an 83B election, that sort of thing.
So I hand the company a check, they hand me a stock certificate, I legally own the shares.
Legally, yes, you're a shareholder. But for accounting purposes under ASC 718, you don't own a thing yet.
That's so counterintuitive. I paid cash.
But look at the strings attached. If you leave the company before that stock vests, what happens?
The company buys the shares back.
For what price?
Usually what I originally paid. My cost.
Exactly. So you have no downside risk. If the stock price crashes to zero and you quit, you get all your money back. You haven't taken on the risks of ownership yet.
I see. The transaction isn't substantive yet.
Correct. ASC 718 treats those shares as if they are still options, the cash you paid. The company books that as a liability, a deposit liability.
It's like a security deposit.
Until the vesting date. Once the shares vest, the repurchase right goes away, the risk transfers to you, and then the company reclassifies that liability to equity.
Does it change the total expense recorded?
Surprisingly, no. The grant date fair value is the same. But if it's really common, it might lower your expected term assumption because people are exercising right away.
That brings us to the main event, the IPO itself. We have IPO contingent vesting in Section 13.4.
This is incredibly common. You grant an award, like RSUs, and the vesting says, you get these if you stay for 3 years and we have an IPO.
A double trigger.
Yeah.
Service and performance.
But here's the rule that catches everyone. Under U.S. GAAP, an IPO is generally not considered probable until it actually happens.
Wait, really? Even if you file the S1?
Yeah.
Even if the roadshow is happening?
Generally, yes. The mindset is that an IPO can be pulled at the very last second. So until it's effective, it's not probable.
So, if I have these awards out there for 4 years while we build the company, how much expense do I accrue?
Zero.
Zero for 4 years.
Zero. Because that performance condition isn't probable yet.
Okay, so then the IPO happens, the bell rings, we're public.
And the accounting department has a heart attack. Because on that day, the condition is met. You have to recognize all the cumulative expense for all those past years in a single moment.
The big bang.
Exactly. Your first quarter as a public company is going to get hit with a massive, massive comp charge. It's a vital disclosure to make to investors ahead of time.
You don't want to blindside Wall Street.
Never.
All right, final concept before the quiz. Liability awards, Section 13.5. We know if you settle in cash, it's a liability, and for public companies, that means marking to fair value every quarter.
Which creates a lot of noise in the P&L.
But private companies get a choice here.
They do. It's another policy election. Private companies can choose to measure liability awards at fair value, like public companies, or they can measure them at intrinsic value.
Remind us of the difference.
Fair value is the whole Black-Scholes value, time value, volatility, all of it. Intrinsic value is just the spread, current price minus the exercise price.
Intrinsic seems way easier to calculate. Why wouldn't everyone do that?
It's easier math, but it might actually be more volatile for your earnings. Intrinsic value moves dollar for dollar with the stock price. Fair value dampens that movement a bit.
That's a subtle point. So easier math isn't always smoother earnings.
Correct. And it's a temporary solution anyway. Once you go public, you have to switch to fair value.
Okay, we've navigated the maze. We've covered peer groups, the midpoint term, the big bang IPO expense, and the intrinsic value choice.
That's the core of Chapter 13.
Now, let's see if it's stuck. We're going to do 3 rapid-fire questions. I'll set the scene. You give the answer.
Let's do it.
Question 1. A private company grants at-the-money options with a 4-year vesting schedule and a 10-year contractual term. They want to use the practical expedient for expected term. What number should they use?
Okay, think about the formula. Vesting plus term divided by 2.
And the answer is?
7 years. 4 plus 10 is 14. Divide by 2. Simple average.
Perfect. Question 2. A private company has awards that vest only upon an IPO. It is year 5. The company has filed its S1. The IPO is scheduled for next month. How much cumulative expense should the company have recognized by the end of year 5?
This is the probability trap. Remember the Big Bang?
That's the number.
0. Even with the S1 filed, the IPO isn't considered probable until it is effective. No expense is booked until the event actually occurs.
0 expense. That one trips people up every time. They want to accrue something.
Don't fall for it. GAAP is conservative.
All right, last one. Question 3. True or false? A private company has cash-settled appreciation rights, a liability. They must use the Black-Scholes model to determine the fair value of this liability.
Think about the policy choices. Private versus public.
True or false?
False. Private companies can make a policy election to use intrinsic value instead of fair value for liability awards. They aren't forced into the Black-Scholes model.
There you have it. If you went 3 for 3, you are in great shape for the private company questions on the exam.
And if not, don't panic. This chapter is tricky. Just focus on those practical expedients. The shortcuts are really the key.
Before we sign off, I want to leave everyone with a thought to chew on about that cheap stock issue.
The 2020 hindsight.
Right. If the SEC determines that your stock was undervalued, doesn't that inherently mean the reasonable valuation method you used, that 409A report you paid for, wasn't actually reasonable?
That's the million-dollar question. It highlights that gap between regulatory compliance and economic reality. You can follow every rule in the book and still get hammered because the market decided your company was worth more than your accountants did.
So compliance is a shield, but it's not always bulletproof.
Well said.
Thanks for listening to this deep dive. Good luck with Chapter 13.
Go get 'em.